My name is Flash Isaac, and I'm a teacher from the future. When I was much younger, I saw thousands and thousands of people fail Jamb and unable to gain admission. This made me travel in time. Now I am back with the Flashlearners Jamb app and a series on YouTube tagged 120 Days to Jamb. My mission is to help you blast Jamb and as well get justice for everyone who Jamb has served breakfast. We are welcome to episode number 48 of the 120 Days to Jamb comments with Flash Isaac. In the previous episode, we discussed central bank, and we also said that central bank acts as bank to every other commercial bank, and we said that central bank controls commercial banks. Now, how does the central bank control the commercial banks? Or how does central bank act as banker to every other bank? It is simply by implementing certain monetary policies. What are monetary policies? Monetary policies are certain policies, rules put in place by the central bank to control the flow of money in the economy. And this monetary policy can be of two types: expansionary or contractionary or restrictive. Expansionary is when these monetary policies are made to increase the flow of money in the economy, while the contractionary monetary policies are policies by the central bank to reduce the flow of money in the economy. And these are top 7 monetary policies by the central bank. The first is cash ratio, also called liquidity ratio. The second is bank rate. The third is legal reserve requirements. 4, special deposit. 5, open market operation or more. 6, selective credit control. And 7, moral suasion. These are the monetary policies. Now let's look at them one after the other. Cash ratio slash liquidity ratio. Now, liquid, when I say I am liquid, it means I have a lot of cash at hand to spend. If I say I am not liquid, it means I don't have cash for now. So liquid can also be used to refer to as cash. Liquidity or cash ratio is simply the percentage of money, the amount of money these commercial banks need to deposit to central bank for every deposit they receive. For amounts, or for every amount that the commercial bank receives as deposit, there is a particular amount or portion they need to give to central bank, and that is referred to as cash ratio or liquidity ratio. The lower the cash ratio, the more money will be available for the economy. But if the cash ratio is very big or very large, obviously the less the money will be available in the economy. It therefore becomes contractionary monetary policy. If the cash ratio is small, it means the commercial bank need to deposit just more money out of their deposit to the central bank. As such, there will be more expansionary. Now, bank rate is simply the interest the central bank charge for every amount they give out to the commercial banks. Central banks, they can loan the commercial banks, they make money available for the commercial banks. So now, the interest or the amount they will collect out of every money they deposit to the or they give to the commercial banks is referred to as bank rate. If the bank rate is high, obviously less money is available in the economy. If the bank rate is low, more money is available for the commercial banks and for the economy. Legal reserve requirement is the minimum amount every commercial bank must keep with central banks for them to still be operating. GT Bank, Guaranty Trust Bank, United Bank for Africa, Zenith Bank, Eco Bank, Heritage Bank, whatever, FCMB, First City Monument Bank, whatever, all of them, they must keep certain amount in the central bank for them to continue operation. If they don't meet up to that minimum, they will fold up. And I think as at now, the legal reserve requirement for central bank, it should be around 25 billion that you must keep for you to be operating as bank. You must keep that one, it must be there permanently. That is the minimum that must be with the central bank. So now, a situation where this legal reserve requirement is lower or is very low, there will be much money available for commercial banks and in the economy. But if you increase the legal reserve, it means you are keeping more money, so less money is available for commercial banks and less money in the economy. And special deposit is another additional money that the central bank may request outside the cash ratio for banks to still keep with them. You see that even these commercial banks, they go through a lot of policies. Don't do this, bring that, submit this. Even after central bank gives policy, don't give anybody more than $500, don't do that. It is the commercial bank customers will blame and cost, but it's central bank that's actually making most of these policies and forcing them on the commercial banks, whether they like it or they do not like it. Open market operation is the purchase or sales of securities by central banks, like the purchase or sales of shares of stocks. These are open market operation. Selective credit control is simply the instruction to commercial bank to know the people they lend money to control lending. While moral suasion is a plea from the central bank to commercial banks for them to reduce how they give out loan. You see that there are a lot of policies the central bank put in place to control every other bank, and they are referred to as monetary policy. I do hope you found one or two things interesting in this class. If yes, let me know how you feel using the comment box. And don't forget to install the Flashlearners down application. Go to any of your app, Play Store, you see all those apps there. Or visit flashlearners.com to install the various versions of the app, desktop and all the versions there are to it. And you see all these topic, questions and answers on the app. It is going to help you pass. And you can reach out to me directly if you need to make it personal. See you in the next episode.